Hi, I'm Mijun from Mikjushin University. Let's begin today's Mikjushi news for December 15th. Welcome to Mijun, where we continue to uphold the fundamentals of United States stock investing as always. Mijun Bayam, everyone, I hope you had a great weekend. Thank you for joining me for the first broadcast of the new week. It's already the middle of December. The Christmas spirit hasn't reached the United States stock market yet, especially since the tech and growth stocks we love are experiencing corrections. As I mentioned last Friday, there's a cycle of money rotating in the market. So the investment funds are moving out of the artificial intelligence beneficiaries and tech stocks that have been soaring until now, and we're seeing money rotate into the other stocks and sectors that have been underperforming so far. As tech stocks have been falling like this, the term artificial intelligence bubble has naturally been dominating the media these days. For the paid members of Mijun, I translate various articles and share my personal interpretation and analysis of those translations. If you look at the United States media over the past 2 or 3 days, there have been so many articles about the artificial intelligence bubble. Here, you can see articles about the collapse of the artificial intelligence bubble that Wall Street is talking about, and also in the Mijun recommended content. Some investors sell winning stocks to buy others, as shown here. Is the collapse of the artificial intelligence bubble imminent? So suddenly, various media outlets are talking a lot about the artificial intelligence bubble and instilling fear again. So today, as we start a new week, even though it's a rather heavy topic, I thought it would be good to read together an article about the artificial intelligence bubble, which has recently caused a lot of concern among investors. All right, then let's get started right away with today's United States stock news, prepared a bit briefly for December 15th. Before we talk about the artificial intelligence bubble story prepared for today, let's first check the market conditions to see what happened in the United States stock market over the past week. First, if you look at the S&P 500 map, I've set the period to 1 week, and the S&P 500 map is showing the current state of the United States stock market as it is. Overall, the number of green is overwhelming the red. There were a lot more stocks that went up, but the important thing is that only the artificial intelligence beneficiaries and tech stocks went down. So right now we can see at a glance that the market is showing a rotation of funds. I've emphasized before that a rotational market is by no means a bad thing. That means the funds that were in the market are leaving the market, and the fear index also reflects that the current market sentiment is good. It's now down to 15.74. Does low volatility mean there are fewer risk factors? The atmosphere is such that the funds in the market are likely to stay for a long time without leaving. It's just that the funds have moved from the artificial intelligence beneficiary stocks we favor to other areas, and we can confirm this here as well. But if you look at the fear and greed index, it's not an atmosphere where people feel excitement as stock prices keep rising. Right now it has dropped 1 level from neutral to slight fear. For example, if this index rises to greed or even goes past greed to extreme greed, only then does the word bubble become appropriate. Right now, even looking at the fear and greed index, the word bubble doesn't really fit. With so many people in the market feeling worried and fearful, you have to wonder, where is the bubble? That's the kind of indicator that's been released, so you can look at it this way. Let's take a look at the performance of Mijun top picks over the past week. Fortunately, about half of the Mijun top picks ended in the positive. That's because Ethereum and Bitcoin showed gains. In the past, when only Bitcoin and Ethereum were falling and only artificial intelligence beneficiary stocks were rising, it made you wonder if analysis was even necessary. But over the past week, the opposite happened. ETHT closed up 2.63% and Ethereum was at 3,139 Ethereum and Bitmine emerged. Bitmine emerged, recorded up to tie and so on. Bitmine also rose 1.63% and Bitmineering coin was at 89,800. With a bit more effort, it should surpass 90,000. Palantir finished the week up 1.00%, Tesla up 0.87%, and Tele Energy up 0.60%. The rest of the stocks are in the red. Coinbase dropped slightly by 0.84%. Taiwan Semiconductor Manufacturing Company is down 0.91%. First Solar down 1.09%. Advanced Micro Devices down 3.30%. Alphabet down 3.73%. Nvidia down 4.05%. Meta down 4.33%. Celestica down 5.72%. And Broadcom down 7.77%. Lastly, Credo plunged more than 18%, performing the worst. And what do the stocks that showed a sharp decline over the past week have in common? These stocks had the best price trends in the past 6 months. Stock prices have noticeably declined over the past week. If you look at the 6-month returns, Credo is up 93%. Avgo and Broadcom are also up 40%. Celestica is up 134%. Google is up 76%. And Advanced Micro Devices has also risen by 77%. So now, funds are moving out of stocks that have risen a lot and into those underperforming stocks that haven't been doing well, and we could see this trend in the MyZone top picks as well. Alright, then let's read the article prepared for today together. If you look at the title of the article, recently, it seems that investors are selling winning stocks and buying the others. First, let's read through the article. Artificial intelligence-related stocks, which had briefly paused, trended downward in the market last week. That's because investors have started moving their investment funds into assets that seem to have value. What I mean by assets that seem to have value is this. Think of it as stocks with sharply lower valuations. Now, at this point, we need to take a moment to interpret what value or valuation really means. We keep repeating the formula that stock price equals earnings times multiple. Now here, one part is earnings and the other part is valuation. Valuation is basically the market's expectations. So depending on how high the expectations are for future performance, even if the earnings are the same, the stock price can go up or down. So, when we say something smells like value or has a scent of value, this is what we mean. That means these are stocks that the market doesn't really expect much from, and we can interpret this in a somewhat negative way. So if we interpret this sentence, it could mean that funds have moved into stocks or sectors that have been ignored by the market until now, with high valuation. Is it because of earnings, or is it due to the low price earnings method for scaffolding? There's no way it will happen, and the economy won't go into a recession either. So while maintaining a moderate growth rate, it doesn't fall, it doesn't crash, nor does it surge rapidly. It's a place that steadily rises, not too hot and not too cold, like a Goldilocks zone. That's how you should see it. Josh Schachter, the Chief Investment Officer of Easterly Snow, appears. It's a typical rotation where people move out of stocks that have performed well so far and into stocks that have been relatively neglected. I share the same opinion on this point as well. Bob Savick, the head of market macro strategy at Bank of New York, is coming up. This expert concisely explains why investors' outlook became more optimistic after Chairman Powell's remarks. In the end, a stronger economy and lower interest rates can drive up overall asset prices in the market. I mentioned this last week as well, and now there's the economic outlook announced by the Fed. There are two main points in it. The first is that inflation will gradually decrease, so interest rates will also continue to be lowered. Of course, they will adjust the pace at which they lower the rates, and this part could be interpreted negatively by us. But the important thing is, the direction is still towards lowering interest rates. And the second point is, the economy is brighter than we thought, and there was an announcement that the gross domestic product growth rate for next year was raised higher than we expected. So does that mean we've found the best combination where interest rates are falling and the economy is rising? So this expert says, the fear of recession that dominated the market last year has now shifted to a broad consensus on economic resilience. Expectations for a soft landing in 2026, based on about 2% United States growth and about 3% global growth, are still valid. This is supported by continued fiscal stimulus, artificial intelligence, driven productivity improvements, and the possibility of easing policies by the Fed. So, objectively speaking, the current situation is being summed up as very good. First of all, we can expect the United States gross domestic product growth rate to exceed 2%. But it's not enough for only the United States to do well. Ideally, the whole world should be doing well. Currently, we can also project that the global growth rate will reach about 3%. Is the expectation for a soft landing in 2026 still valid? Another thing is the ongoing fiscal stimulus. President Trump is known for supporting businesses, so he plans to continue injecting money into the market through fiscal policies. As the artificial intelligence revolution accelerates, many companies are adopting artificial intelligence. Does adopting artificial intelligence improve productivity? That means there's a possibility that companies' margins will increase. And finally, if the Fed's easing policy continues and interest rates keep dropping even a little, eventually interest expenses will decrease and there's a high possibility that companies' earnings will improve. And what's even more important is this. The signal has finally come out that the Fed has stopped the long-term tightening it had been implementing. Even though they're not buying long-term government bonds, they said they'll keep buying short-term ones to boost market liquidity. So right now, originally there have been a series of good announcements for stocks, but only our favorite tech stocks have fallen, which proves the point. Growth stocks, mainly in information technology and communication services, have driven the stock market's rise over the years. Information technology covers information technology, semiconductor, and artificial intelligence beneficiary stocks, while communication includes companies like Google and Meta. Because of this, the influence of large tech stocks within the S&P 500 index has grown to its highest level in decades. And some have warned about the risks of this excessive concentration. The decline of leading artificial intelligence stocks is making some investors uneasy. However, in the midst of this, Matt Otter, the chief strategist at Raymond James Investment Management, interprets this downturn as simply profit-taking. Therefore, he says, he expects that the further decline in technology and artificial intelligence-related stocks will likely be limited and that investors will step in to buy during any corrections. So, what this is saying is that people have been selling to realize profits because stock prices have risen a lot, but once the prices drop to a certain level, they'll start buying again. It's just a valuation issue, as they say. The fundamentals are unchanged, right? At the same time, the fact that funds are moving into cyclical stocks like small caps, financials, and industrials is sending a positive signal about the economy. Usually, small caps are very sensitive to the economy. It's the same for financials and industrials. So if you look at where the money is flowing during this rotation, small caps, financials, and industrials are the best. That means the economic outlook is continuously improving, and you can interpret this positively. So the economic outlook is getting better, inflation is coming down, and the current market is experiencing a healthy rotation beneath the surface. That's the conclusion. But despite these positive signs on Friday, they couldn't stop the overall decline. On Friday, all three major indexes ended in the red. What's the reason for that? It's because the selling pressure that started in artificial intelligence trades spread to other sectors, increasing the pressure on Wall Street. That's because artificial intelligence beneficiary stocks make up such a large portion of the S&P 500 and the Nasdaq indices. If artificial intelligence beneficiary stocks fall, it's very difficult for the overall market sentiment to be good. That's how you should see it. Nevertheless, the rotation trend continued. As of Friday, the Dow Jones Industrial Average's 3-day relative performance compared to the Nasdaq Composite and the S&P 500 reached its highest level since January 27. Also, the price ratio of growth stocks to value stocks has dropped to its lowest level in several months, as the trend of avoiding overvalued stocks continues. So now, if you compare the prices of value stocks and growth stocks have always been rising steadily. But this graph has finally turned downward. Currently, since growth stocks have been running too far ahead on their own, we can see here once again that funds are moving into value stocks, specifically. There's the iShares Russell 1000 Growth Exchange Traded Fund, and there's also the iShares Russell 1000 Value Exchange Traded Fund. These are the ones. These ETFs track the top 1,000 United States companies by market cap. The first holds only growth stocks, while the second includes only value stocks from those companies. And when I kept comparing the price ratio of these two, as of Friday's closing price, it fell to 2.2, which is the lowest level since September 2nd. That means growth stocks have been falling these days. That's how you can see it. This ratio peaked on October 29th when the tech-heavy Nasdaq recently hit an all-time high and has been continuously declining since then. That's how you can see it. Josh Schachter is now appearing. As interest rate cuts proceed, we expect that small-cap stocks, especially regional banks, are likely to be positively affected going forward. These banks make up a large portion of major small-cap indices like the Russell 2000. So, if small-cap stocks do well, the Russell 2000 will likely keep rising for now. And at the center of that, financial stocks like regional banks will play a major role. And he also predicts that cyclical sectors like financials, industrials, and energy could benefit as President Trump's tax cuts increase consumers' disposable income and improve corporate profit margins. What about Mayatoteo? The rotation so far looks healthy, but if the market's leading sector shifts to defensive stocks, the situation could change. Earlier, we talked about how it's very important to see where the money that left the cyclical stocks is going, right? Right now, it's going into cyclical stocks like financials, industrials, and energy, isn't it? But if the money doesn't go into these sectors and instead goes into defensive stocks, that's what we call defensive stocks. We're discussing healthcare and consumer staples, and if money shifts there, it's a bad sign. That's how to interpret it. That's because when an economic slowdown is expected, investors usually move into sectors like consumer staples, healthcare, and utilities. Recently, healthcare stocks have performed well, but that's only part of it. The reason healthcare is rising right now isn't really due to economic factors or because an economic slowdown is expected. It's much more influenced by current policy issues and political factors. I think it's more reasonable to see it that way. Generally, value stocks refer to stocks that are traded at a price lower than their intrinsic value. They often pay dividends and have a low price-to-earnings ratio. On the other hand, growth stocks are companies expected to have rapid earnings growth in the future. Growth stocks have outperformed value stocks for over the past 10 years. Even in this bull market that started after October 2022, there have been several rotations, but in the end, tech stocks keep regaining market leadership, and this pattern keeps repeating. Growth stocks have outperformed value stocks for over a decade, leading some to claim growth stocks will now decline while value stocks rise. I don't think so. In the past, when I compared the value of the Korean won and the United States dollar, you know how recently the value of the won has kept dropping. But if you look at this on a chart, this trend has continued for the past 5 or 10 years. So when this trend is shown on a graph, rather than expecting it to suddenly reverse, if this trend has continued for the past 5 or 10 years, isn't it more reasonable to predict that the same slope will continue in the future? That's how I always see it. If growth stocks have outperformed value stocks for over 10 years, they may continue to do so for the next 10 years. This is because there was a reason growth stocks outperformed value stocks for so long. And now, as the era of artificial intelligence is in full swing, I personally think there is an even higher possibility that this trend will become stronger. However, there is also a possibility being raised that this rotation could reach its peak during this test period. Adam Turnquist, the chief technical strategist at LPL Financial, points out that the rise in long-term Treasury yields is a variable. As of Friday, the 10-year United States Treasury yield rose to about 4.2. He says that right now is a critical point that determines whether this rotation will survive or collapse. If Treasury yields keep rising, the rotation will end and the entire stock market could fall. That's how much rising Treasury yields are absolutely toxic. The worst thing for the United States stock market is ultimately Treasury yields continuing to rise. That's how you should see it. When Treasury yields go up, safe assets become more valuable and attractive. Therefore, Treasury yields need to stabilize, and inflation needs to come down for the stock market to keep running. As the stock market continues to rise, that's when rotation keeps happening. I think that's how we can sum it up. Let me summarize the current situation in one word from Miji Won. With rising concerns over a potential artificial intelligence stock bubble, What are your thoughts on the current rotation of investment funds in the market? I actually think we can interpret this in a positive way, especially for investors like us who have portfolios focused on artificial intelligence beneficiaries. I don't think the current trend is necessarily a bad sign. That's because a rally where only artificial intelligence beneficiary stocks rise unilaterally is structurally difficult to sustain for a long time. When too much capital is concentrated in a specific theme, if stock prices keep rising without any correction or pause, the market is bound to be shaken significantly, even by a small disappointment. So, in that sense, the recent rotation between growth and value stocks, and especially the profit-taking in artificial intelligence beneficiaries within the tech sector, shows that the market is self-regulating, it's overheating. That's how I see it. So I actually think the current circulation of funds happening right now is more like a kind of safety device that preemptively controls the artificial intelligence bubble. That's how I see it. Since the end of 2022, artificial intelligence beneficiary stocks have started to take off. And what's really good is that whenever these artificial intelligence beneficiary stocks get too hot from all the attention, a correction comes in. So the fact that these frequent and shallow corrections are happening, it's not a negative thing at all. In fact, you could see these corrections as a welcome development that could actually help prolong this artificial intelligence rally. Moreover, if you look at the economic outlook summary announced by the Federal Reserve last week, it is expected that the United States economy will continue relatively healthy growth over the next few years, while inflationary pressures will gradually ease. The combination of growth and price stability is an ideal macroeconomic environment for improving corporate earnings, isn't it? The basic principle that determines stock prices is that the official stock price is calculated as earnings multiplied by the multiple. What's happening in the current market is relatively clear. The reason is that the current rotation market is a process of normalizing the previously soaring multiples of artificial intelligence stocks to a reasonable level. So even now, although Broadcom announced its earnings and the stock price dropped, the important point is that most artificial intelligence beneficiary stocks have very good earnings. Their growth rates are accelerating and their margins are continuously rising. In that situation, the reason why stock prices keep falling even after earnings are announced is because of this normalization. In the end, it's possible to interpret this as multiples being adjusted because they had risen too high and are now calming down. If during this process artificial intelligence beneficiary stock multiples become more normalized, the market's attention will naturally shift to who is actually making real money. In other words, to earnings growth. Earlier in the value stock competition over the past 10 years, growth stocks stood out with remarkable price increases. For 10 years, growth stocks consistently outperformed value stocks, and the reason is that their earnings growth was just so strong. What about this investment capital? In the end, it has no choice but to focus on which company is actually making money. But the long-term trend doesn't budge from here. In the short term, even if a company is making good money, if the PER multiple rises too much, it goes up when it drops in the short term, and if the rally gets too hot, it falls again. These kinds of short-term adjustments have been repeating. This is how you should see it. And if you think about which sector has the clearest visibility in terms of earnings growth, I believe it's still highly likely that artificial intelligence beneficiaries will remain at the center. Of course, in the short term, volatility could increase even more, and stock prices could keep falling for a while. Even if earnings are good, if stock prices keep dropping, it can feel really frustrating, or even make you fear that the bubble is bursting. However, it's important to remember that after a multiple adjustment, when earnings are actually confirmed, investment funds tend to return without exception to the stocks with the most distinct earnings growth. In the end, I think the rotation we're seeing in the market right now is not so much a sign that the artificial intelligence theme is ending, but rather a process for the artificial intelligence centered rally to continue in a healthier and more sustainable way. On the contrary, a market where only artificial intelligence beneficiary stocks keep rising without these kinds of adjustments and rotations, that's actually the hottest phase we should be most cautious about. I'll wrap it up here. The last content prepared for today is today's United States stock video. Today's video features several experts, and these experts are evaluating the sharp drop in Broadcom's stock price after last week's earnings announcement. Well, I think it's a good video that makes you think about Broadcom, which is the main topic, and the future of artificial intelligence beneficiary stocks connected to Broadcom. That's all for today's stock news on December 15th. Thank you for joining us for this week's first broadcast. Starting this week, the kids are on vacation for 3 weeks, so it looks like the amount of United States-China broadcast content will be a bit less during these 3 weeks. I'm trying my best to upload videos every day, even if they're short, so please don't think the broadcasts suddenly look half-hearted. Even though I'm busy, I'm still making broadcasts regularly, so I hope you'll look at it positively. Let's keep fighting together until we all retire by investing in United States stocks. Have a great day. Thank you.
Based on our discussion, how do you interpret the stock price reaction?
Do you see this stock as one that gives reassurance to the entire sector? Negative sentiment is spreading in the chip sector, but despite the Oracle issues, semiconductors are still outperforming the market. Even if you just look at the last 4 or 5 days, I'd like to remind you where the market leadership has been. The main point about Broadcom is its connection to Google TPU. As the company's role in the custom chip sector and the market's outlook on the future direction of the semiconductor industry come together, Broadcom has gained much greater resilience compared to other stocks. That's why, to be honest, I don't really understand the current valuation multiples. Dan, I notice a slight smile. Is it because of my sweater? I think it's because of your expression, but in my opinion, this issue is giving some relief to the entire sector, and especially for companies that haven't gone all in on large-scale capital investments, it's acting as a positive signal.
Is this trend also a factor that brings relief to Nvidia, or is the success with TPUs being interpreted negatively for Nvidia?
In my opinion, it's not bringing any relief to Nvidia. Nvidia's stock price is about 16% down from its all-time high, so it's a different story. If we take a closer look at this quarter, free cash flow was weak and the 44x forward valuation is high, but operating profit margin has improved over last year and the company is performing well. Their business structure is clearly high margin. In the end, the key is how to interpret the valuation, but the current market doesn't seem to care much about this aspect.
I also agree about their dominance. I see some negative aspects of these changes for Nvidia. The overall market is growing, and I believe in that. But for a time, Nvidia essentially owned the entire market, which led to high margins. Now, as their market share becomes less dominant, their margins will inevitably be diluted.
I want to point out 2 things about the margins. First, the price of memory, including high bandwidth memory, continues to rise significantly. This has played a big role in supporting the margins, and considering the current price environment, I think the margins are being maintained quite well. Second, this concerns Nvidia. The market keeps saying it's just the beginning and will grow further. From Nvidia's perspective, this statement might sound negative. The pie keeps getting bigger, but now, instead of Nvidia taking it all, other players are sharing it. Even just looking at today's Rivian case, they chose not to use Nvidia as they build their own artificial intelligence. And to point out something about Broadcom, Broadcom is making chips for Google, and they're the ones producing the TPU, right? There's a high possibility that Google's next generation TPU will become much more internalized than now, which could actually be a negative factor for Broadcom. SemiAnalysis addressed this point accurately in a research report released in the last 24 hours. Rather than being an immediate issue, I think this is a point to keep in mind when looking at this stock over the next 12 months or so.
Despite the valuation burden, I choose Broadcom. Broadcom's stock is up about 75% this year, while Nvidia is up 35%. The market shift to custom chips is making Nvidia uneasy, which I think will force Nvidia to give up some volume in the future. The case of Rivian is a clear example that shows where the market trend is heading. Nvidia has overcome crises several times by coming up with solutions, but now I think there might not be any more tricks left up their sleeve.
We've talked for a long time about the dynamics of custom chips entering the market in earnest, but looking at the recent achievements of Gemini, I feel like we haven't talked enough about the success of the TPU, which has been developed over the past 10 years. At some point, things suddenly happened and became reality, and in that process, Nvidia seems to be struggling to respond well to those changes.
Everyone's discussing the same context, and that's my view. I think there are definitely risk factors for some companies that have significantly outperformed so far. I think the message the market is sending today is that organizations that are slim, flexible, able to quickly evolve in line with industry trends, can customize and don't have excessive capital investment or asset burdens, can actually feel reassured. No one is questioning the demand. Ultimately, the core of all these discussions is demand, and that demand story remains unchanged, but there are still warnings. I think the sense of relief the market is giving today comes from this very point. However, as we've discussed, if you're one of the legacy players who have taken the lion's share so far, the story could be a bit different.
Yes, so if we go back to the question Christina mentioned about who that fourth customer is, it's highly likely that the customer is OpenAI. Anthropic. The two companies are essentially similar, but at this point, in terms of chip demand, OpenAI is much bigger. If open artificial intelligence falters, meaning if the Stargate project that we're all expecting doesn't proceed as planned, demand will inevitably drop immediately. It's a really simple story. In the end, a significant part of this artificial intelligence demand story is directly connected to open artificial intelligence as demand. Anthropic definitely exists and is doing a lot of work, but in terms of scale, it's a much smaller player. In the business world, it seems like Sam Altman absolutely has to make this work succeed. I'm not saying the whole artificial intelligence trade will collapse if this fails, but there's a good chance we'll see a major correction in 2026. We'll see.
If we connect this to what you said about memory prices being high, do you think that's why Micron is rising in after-hours trading? But looking at the overall reaction in artificial intelligence trades today, before Broadcom's earnings announcement, Microsoft was up about 1% and Meta also rebounded slightly, but overall the movement was quite limited. Even so, today was an interesting day with a rotation into artificial intelligence, related stocks that had been under pressure for a while. Let's take a look.
In the case of Microsoft, I see it as a bit of a relief rally. Since the stock price has been corrected quite a bit over the past few weeks, I think it's natural to interpret this as a rebound. I can actually understand this for Meta as well. Regardless of whether the stock price can go down further, it has already come down to a pretty low level. And at that point, I think the market briefly recognized, even though we see spending pressures, doesn't this company still have tremendous advantages? The valuation is still at an attractive level as well. So investors are putting their money in, and I think that decision is quite reasonable.
The start of a small dream is important. Let's plan a hopeful future together, growing little by little every day. Is there excitement blooming in the night? Let go of greed, I won't lose this time either. The result is just a continuation of the process. I'm not afraid even if a dark adjustment comes. Holding tightly to your hand, I'll become the light of an unseen tomorrow. Let's make a happy investment, cheering on each other's dreams, and walk together down this beautiful downhill path. A happy investment with me, Ju. Let's boldly become national stockholders together until we retire.
Is it uploaded every Sunday?